This video is the second in our Finding Balance series, where we've asked ourselves how the future really looks from financial institutions and what the medium and longer-term impact of COVID-19. The financial impact varies from bank to bank. Given reduction in central bank base rates early in the crisis, net interest margins will remain limited, and while borrowing is increasing, for example through corporate drawing down on lines of credit, any gains may be offset by bad loans. In fact, credit losses are likely to be significant. In retail banking, specific groups of retail customers are particularly vulnerable: the self-employed, the hourly paid, and those with unsecured loan products. In commercial banking, lending to travel, tourism, and entertainment are the worst affected, as are the oil and gas sectors because of lower consumption, geopolitical factors, and sustainability policies. Given the Basel III international capital adequacy reforms since the last crisis, market sentiment suggests that most banks, and especially the systemically important ones, are unlikely to need to raise capital to strengthen their balance sheets. That is not to say weaker, smaller banks, which have yet to fully overcome the effects of 2008, won't do so in future. By providing support to consumers and business, drawing on their substantial capital and liquidity buffers, in marked contrast to 2008, banks are mitigating the impact on the economy as a whole, and as a result, limiting their own credit losses and protecting their capital positions. As a first step, they will have identified those industries and market sectors worst affected by COVID-19 through analyzing and monitoring the economic environment. McKinsey & Co. advocate reverse stress testing to identify the worst-case scenarios, a common regulatory requirement. Scenarios should be developed around not only the macroeconomic, but the human reaction to the disease, for example, willingness to socially interact, including the governmental response and intervention. Crucially, existing assumptions on which present business models are based should be revisited, as they may no longer be relevant. In the light of lower revenues and with disrupted business models, banks will be considering how to reset their costs to a level that allows them to be profitable in changed circumstances. In this way, the pandemic provides an opportunity to embark on radical change to completely redefine how they want to operate in a post-pandemic world. While avoiding excessive pro-cyclical effects is obviously prudent, so is a willingness to recognize non-performing loans and book losses. To date, US banks, encouraged by their regulators, are being most realistic, in contrast to EU banks that are taking a softer approach. This is important because, as the 2008 financial crisis demonstrated, banks saddled with debt tend to be less able to lend and their share valuation suffer. Banks are being required by central banks to take in climate change into account when assessing the adequacy and resilience of their prudential strength. Together with the asset management sector, they face commercial and competitive pressure to prefer sustainable lending and investments. The voluntary recommendations of the Task Force on Climate-Related Financial Disclosures, TCFD, are being supplemented by mandatory disclosure requirements. For example, under the European Commission's Action Plan on Sustainable Finance, technology is transforming banking by opening up the sector to competition, introducing new services, and disrupting incumbent business models. COVID-19 is accelerating existing trends towards digitalization, for example, through remote working and delivery of financial products. The cost towards retail branch closures continues. The ability to cut costs through technology is especially important as the number of non-performing loans grow. And in Europe, low rates of return for banks are squeezed even further. Small, virtual-only banks can really benefit from cost efficiencies, providing significantly higher rates of return than incumbents. This all requires new investment and therefore represents a cost to P&L. I also want to mention operational resilience, which has risen up the priorities of banks and regulators in recent years, has seen its worth paid off. In light of the risk of future pandemics, increasing vulnerability to cyber attack and climate change, it will remain a priority for investment and focus for banks in the future. Regionally, we will see US banks benefiting from earlier recognition of bad loans on their balance sheet and larger Chinese institutions beginning to spread their wings. All this at the expense of European banks that could see weakened balance sheet and lower profitability, and if the politics are right, overdue consolidation. A special mention about Chinese banks that are now significant in size. In 2019, they earned 3 times the amount of investment banking fees than their Asian competitors, excluding Japan. Their share of total lending has increased from 1% in year 2000 to 14% today. If China exits the economic downturn relatively better than other countries, its top-tier banks may finally be a force to reckon with internationally, especially in emerging markets. Other factors supporting this development are China's Belt and Road Initiative and European banks reducing their balance sheet and selling foreign subsidiaries. Arguably, the bank's ability to capitalize on stronger balance sheets and high levels of regulatory scrutiny could leave the sector better placed to lend to corporates than alternative lenders, which, because of fewer controls over their lending, may see higher levels of defaults. We consider, however, that shadow banks are likely to expand their market share due to better access to capital and with less regulation, enjoying greater speed and flexibility. As a silver lining, we see investment banks benefiting from shadow banking through significant fees earned by advising on corporate issuances and underwriting them, compared to the meager interest on loans that sit on balance sheets. Although activity on regulatory enforcement and compliance investigation is currently low, in part because supervisors are focusing on other priorities, such as ensuring customer protection, that markets continue to function well, financial stability, and the availability of liquidity, etc., this will change quickly when business activity returns. For this reason, banks, in common with the financial sector, should maintain focus on their control environment. Regulators have been clear that while some regulatory obligations, such as reporting, may be deprioritized, this does not apply to AML and conduct issues. Future enforcement and compliance activity should also be seen in light of the increasing regulatory scrutiny of the sector, including the holding of individual senior managers to account. When comparing the position to the year 2008, that crisis originated in part because of the misconduct and excesses of the sector, which is not relevant today, so the level of regulatory and compliance action may not reach the same level in the years after 2009. Significant corporate failure impacting balance sheet is unlikely in the short term, except for businesses already in difficulties before COVID-19 emerged. But when corporate borrowers were highly leveraged or suffered poor cash flow before the lockdown, it is unlikely they can now afford more borrowing to survive the crisis, and will see an uptake of restructuring and insolvency activity. Some businesses have been raising more equity, financial markets remain open, or restructuring their debts, but there will be failures leading to reorganizations and insolvencies. An additional factor is that in recent years, a global investment surge has driven a rising debt burden, which combined with ongoing economic disruption has created the conditions for rising defaults. This factor is likely to aggravate credit losses in the present downturn. Clearly, retail, commercial, and investment banking are very different. Interest rates have been cut still further to near zero, or negative levels with a view to boosting the economy. While economic recovery and growth is in the interest of banks, which tend to grow in line with the economy, they will need to offer customers more revenue-raising products and services. Using technological innovation, otherwise retail and commercial sectors run the risk of a low-return utility status. At the same time, they must meet regulators' requirements over their resilience to climate change while they respond to investors' ESG concerns.